Is Dalio's dire prediction a wake-up call or simply fear-mongering? In his latest warning, he cites a dangerous mix of geopolitical tensions, economic imbalances, and a rapidly changing technological landscape as the perfect storm that could bring mayhem to global markets. Billionaire investor and founder of Bridgewater Associates, Ray Dalio, is sounding the alarm bells for an upcoming crisis that he predicts will be unlike anything we've seen before. Smashing the subscribe button to kickstart the video. The perfect storm. Dalio's warning is not unfounded. The global economy is already showing signs of strain, with rising debt levels, trade tensions, and slowing growth in many key markets. At the same time, the rapid pace of technological innovation is disrupting entire industries, creating new winners and losers, and leaving many workers struggling to adapt. According to Dalio, the scale and severity of the upcoming crisis will far exceed that of the 2008 financial crisis, which was caused by the collapse of the subprime mortgage market. That is why Dalio said in a LinkedIn post, "The world has gone mad and the system is broken. This cycle is different. The next downturn is going to be challenging for policymakers." Dalio's vision has implications for investors around the world. He advises investors to brace themselves for significant market turbulence and to prepare for a potentially prolonged period of economic uncertainty. In a recent interview with CNBC, he said, "The biggest mistake investors can make is to assume that things will continue as they have been. We're in a world where things are changing very rapidly, and we need to be prepared for a range of outcomes." Some analysts have questioned the severity of Dalio's prediction, arguing that his warning is overly pessimistic. However, others point to the growing evidence of economic imbalances and geopolitical tensions as evidence that his warning is not unfounded. Regardless of the outcome, Dalio's warning is a reminder that investors need to be vigilant and proactive in managing their portfolios. By staying informed and prepared for potential market disruptions, investors can position themselves to weather the storm and emerge stronger on the other side. While his comments have been interpreted by some as overly pessimistic, others argue that they are necessary to prepare for potential economic turbulence. Brace for impact. The ambiguity surrounding the severity of the upcoming crisis has left many investors uncertain about how to proceed. Some may choose to adopt a cautious approach, reducing their exposure to high-risk investments and increasing their cash holdings. Others may see this as an opportunity to capitalize on potential market fluctuations by taking a more aggressive stance. Regardless of how you choose to proceed, it's important to remain vigilant and informed about global economic developments and to have a clear plan in place for managing risk. By staying informed and prepared, you can potentially mitigate the impact of a market downturn and position yourself for long-term success. One of the major concerns for Dalio is the level of debt in the global economy. Debt levels have risen significantly in recent years, particularly in emerging markets, and there are concerns that this debt could become a major vulnerability if economic conditions deteriorate. In addition, many countries, including the US and China, are running large budget deficits, which could put further pressure on their economies in the years ahead. The political instability in a number of countries, including Venezuela and Iran, is contributing to a more uncertain global environment. In addition, the upcoming Brexit deadline is creating significant uncertainty in Europe. He said in a recent interview with Bloomberg, "We're in a very delicate balance. We're in a world where there are a lot of different forces that are pushing against each other, and it's unclear which way things are going to go." Moreover, geopolitical tensions are also a significant concern for Dalio. Let's see how.
Ray Dalio, stability. Lovely idea, isn't it? Not seen very often. I mean, let's take the UK. Hardly stable.
I think you have to understand the mechanics, the cause-effect. It's a very basic thing. When you produce a larger deficit, you have to sell your bonds. you have to know who the buyers of the bonds are. If you don't have enough buyers of the bonds, you're going to have a buyer's strike. So they're going to sell off. And this is, I think, what happened in the UK is a canary in the coal mine. That if you take what's happening in Europe as a whole, the level of interest rates relative to the level of the inflation rates, and the terrible choice that has to be made about if you raise interest rates, what does that mean to Italy's debt service payments? Who is going to make up that difference? There's just mechanics to this. So I think that we are in a situation generally where there's not coordination. You could take the monetary policy of Japan and it'd be totally different monetary policy. And so, but there's still a trade-off because the bonds are going to go down in value because they're not going to own them. Now the question is, do they go down in value because the currency goes down in value or because the bond price goes down in value? But one way or another, they're going to go down in value. And the interest rate now, with all of this debt and how it's been structured when all money was free and interest rates were low, now an interest rate that is high enough to deal with inflation and also high enough to provide an adequate return for the bond investor is too high of an interest rate for the debtor. So now we have that structural trade-off. And the dominoes are falling in a very, very classic way. For example, if you take high-yield investing, they were called high yield before they were, and therefore risky, before you had an interest rate change. Now you had the risk-free rate go up to 4%, and you have the credit spreads go up to 5%. Now they have a 9% interest rate. That won't work for those. So they are going to have, they're going to be the first ones to go, and you have this series of dynamics. That's the mechanics.
And the fall of the dominoes has started?
Yeah, you can see the fall of the domino starting. You could see it as like, who has the cash? How much cash do you have that are going to get you through? Are you going to have a year or 2 or 3, or don't you have the cash? So I can go on at length, but each of those dominoes, and the dominoes usually fall in the same kind of ways, and they're falling in the same kind of ways. Jamie mentioned they're 9 months. That's a reasonable time frame. If you take a look at the cash flows and you watch those things, that's what it looks like.
Economical and geopolitical tension. The ongoing trade tensions between the U.S. and China have created significant uncertainty for businesses around the world, while the Brexit process has created a similar level of uncertainty in Europe. In addition, political instability in many countries, including Venezuela, Iran, and North Korea, has added to the geopolitical risk. Technological disruption is the third factor that Dalio sees as contributing to the upcoming crisis. Rapid advances in technology are disrupting entire industries, creating new winners and losers, and leaving many workers struggling to adapt. This disruption is also putting pressure on the labor market, with many workers facing job insecurity and wage stagnation. Despite these concerns, there are some reasons for optimism. The global economy is still growing, albeit at a slower pace than in recent years, and there are signs that some of the geopolitical tensions are easing. In addition, policymakers around the world have been taking steps to address some of the economic imbalances, such as tightening monetary policy and reducing debt levels. However, as Dalio has pointed out, investors need to be prepared for a range of outcomes. We're in a world where things are changing very rapidly, and we need to be prepared for a range of outcomes. He said in a recent interview with CNBC, "The biggest mistake investors can make is to assume that things will continue as they have been." Ray Dalio's warning of an upcoming crisis has sparked a heated debate among economists and investors. Is Dalio's warning overly pessimistic? While some agree with Dalio's assessment, whereas some are against his stance. On the one hand, Dalio's warnings are not without merit. The global economy is facing a number of challenges, including a slowdown in growth and increasing trade tensions between the U.S. and China. In addition, many countries are grappling with rising debt levels, which could become a major vulnerability if economic conditions deteriorate. Dalio has also warned that the current monetary policy environment, with low interest rates and quantitative easing, is unsustainable in the long run. At one place, Dalio said, "Central banks can't keep printing money forever. At some point, you have to pay the piper." However, not everyone agrees with Dalio's assessment of the severity of the upcoming crisis. Some argue that the global economy is in better shape than it was in 2008, when the last major crisis occurred. In addition, policymakers around the world are taking steps to address some of the economic imbalances, such as through increased regulation of the financial sector and efforts to reduce debt levels. So, is Dalio's warning overly pessimistic? The answer is not clear-cut, and the debate over the severity of the upcoming crisis is likely to continue. What is clear, however, is that investors need to be prepared for a range of outcomes, and that diversification and risk management are more important than ever. Before going further in the video to discuss how you can manage your portfolio in tough times, make sure to like the video and subscribe to our channel to see more amazing videos in the future. Managing your portfolio in times of crisis. Managing your portfolio in times of crisis requires staying informed and taking proactive steps to mitigate risk. One important step is to stay informed about global economic and political developments. Keep abreast of the latest news and analysis from reputable sources, and pay attention to key indicators such as GDP growth, inflation, and unemployment rates. This will help you to identify potential risks and opportunities in the market. Ray Dalio emphasizes the importance of diversification in managing risk. This means spreading your investments across different asset classes, sectors, and geographies to reduce exposure to any one area of the market. In a recent interview with CNBC, he said, "Diversification is the only free lunch in investing. By spreading your bets, you reduce the risk of any one investment dragging down your overall returns." Another important strategy is to have a plan in place for dealing with market disruptions. This should include setting clear investment goals and objectives and establishing a risk management framework. Consider working with a financial advisor or investment professional who can help you develop a customized plan tailored to your specific needs and risk tolerance. In addition, it's important to remain disciplined and avoid emotional reactions to market volatility. This means avoiding knee-jerk reactions, such as panic selling during market downturns, and sticking to your long-term investment strategy. One potential risk in times of crisis is the possibility of a liquidity crunch. This occurs when investors rush to sell assets in a falling market, and there are not enough buyers to meet demand. This can lead to a downward spiral in asset prices, further exacerbating the crisis. To mitigate this risk, consider keeping some of your portfolios in liquid assets such as cash or short-term bonds. This will provide a buffer during times of market turbulence and give you the flexibility to take advantage of opportunities as they arise. Alternative investments include assets such as private equity, real estate, and commodities, which often have a low correlation with traditional asset classes such as stocks and bonds. By including alternative investments in your portfolio, you can reduce your overall risk exposure and potentially enhance your returns. However, it's important to carefully evaluate the risks and costs associated with these investments and to work with a professional advisor who can help you navigate this complex area of the market. What do you think about the warnings Ray Dalio gave to us? Tell us in the comments. How things can turn in our way. Maybe time will uncover all the unrest. We'll catch you up in the following video. Until then, take care.